investing can feel like a big, complicated puzzle. We all want to put our money to work so it can grow over time. The dream is simple: buy stocks when they are cheap and sell them when they are expensive. This sounds easy enough, but the reality is much harder. The stock market is a wild place full of emotions, news, and unpredictable events. Trying to guess the exact best day to invest your entire life savings is like trying to catch lightning in a bottle. It is a game of perfect timing that even the smartest experts on Wall Street rarely win. For most of us, this pressure to be perfect can be so scary that we end up doing nothing at all. The biggest challenge isn't finding a good company to invest in. The real struggle is dealing with our own feelings about money. Fear and greed are powerful forces that can lead us to make bad decisions. When the market is soaring high, greed tells us to pour all our money in, often right before a fall. When the market crashes, fear tells us to sell everything, often locking in our losses at the very bottom. This emotional roller coaster makes timing the market a dangerous game. You are not just betting on stocks, you are betting against your own human nature, and that is a very difficult bet to win consistently over a lifetime. Think about all the things that can move the market. A surprise election result, a new invention, a global pandemic, or even a single tweet from an influential person can send prices up or down in an instant. No one has a crystal ball that can predict these events. The world is full of surprises, and the stock market reflects this uncertainty every single day. Believing you can know what will happen next is a form of overconfidence that often leads to disappointment. Instead of trying to be a fortune teller, it is often wiser to accept that we cannot predict the future and find a strategy that works without needing to. This is why so many people feel overwhelmed by investing. They believe they need to be an expert, a genius, who can see the future before it happens. But the truth is, successful investing for most people has less to do with what you know and more to do with how you behave. It is about having a simple plan and sticking to it, especially when it feels hard. The goal isn't to achieve perfection on any single day. The goal is to make steady progress over many years. The good news is that there is a strategy that helps you do just that, without the stress of trying to find the perfect moment. So, if trying to time the market is a losing game, what is the alternative? The answer is a beautifully simple idea called dollar cost averaging. Don't let the fancy name scare you. It just means investing a fixed amount of money at regular intervals, no matter what the market is doing. For example, you might decide to invest $100 every single month. It could be on the first day of the month or the 15th, it doesn't matter. The key is that you do it consistently. You set up a regular automatic investment and let it run on autopilot. This approach completely changes the game. You're no longer trying to guess if the market is high or low. You are simply buying, month after month, through all the ups and downs. When the market is high, your fixed dollar amount buys you fewer shares. When the market is low and prices are cheap, that same fixed dollar amount buys you more shares. Without even thinking about it, you naturally end up buying more of an asset when it is on sale and less of it when it is expensive. This is the magic of the system. It automates the process of buying low. Dollar cost averaging takes the emotion out of investing. You are no longer staring at charts every day, worrying about whether it is the right time to buy. Your decision has already been made. Your plan is to invest your $100 every month, period. This frees you from the daily noise of financial news and the feelings of fear and greed that can lead to poor choices. It turns investing from a stressful guessing game into a boring, predictable habit. And when it comes to building wealth, boring is often very, very effective. It allows you to get on with your life, confident that your money is working for you. The power of this strategy lies in its simplicity and its consistency. It is a system that anyone can follow, regardless of how much money they have or how much they know about investing. You don't need a fancy degree or access to secret information. All you need is the discipline to set up a regular investment and the patience to let it work over the long term. It is a humble approach that acknowledges we cannot predict the future. Instead of trying to be clever, we choose to be consistent. Over many years, that consistency can lead to truly remarkable results. Let's imagine a simple scenario to see how dollar cost averaging works its magic. Suppose you decide to invest $100 every month into a fund. In the first month, the price of one share is $10. Your $100 buys you exactly 10 shares. The next month, the market gets a bit nervous and the price drops to $5 per share. People who are trying to time the market might panic and sell, but your plan is automatic. Your $100 investment goes through as scheduled, and this time, it buys you 20 shares. You just bought twice as many shares because the price was lower, without even trying. Now let's say the market recovers in the third month, and the price goes back up to $10 per share. Your $100 investment that month buys you another 10 shares. Let's pause and look at what you have. You invested a total of $300 over 3 months. You own 40 shares, 10 from the first month, 20 from the second, and 10 from the third. Your average cost per share is not $10, but $7.50. By buying through the dip, you have lowered your average purchase price. This is something that is very difficult to do emotionally if you're trying to time the market. This process helps smooth out the bumps along your investment journey. The market will always have good years and bad years. Dollar cost averaging ensures you participate in all of them. During the exciting bull markets, when prices are rising, you will be consistently adding to your holdings. More importantly, during the scary bear markets when prices are falling, you will be accumulating more shares at bargain prices. These are the times that really build long-term wealth. Years later, when the market inevitably recovers, you will own many more shares that are now worth much more, all because you kept buying when others were fearful. This steady approach turns market volatility, which most people see as a risk, into an opportunity. A falling market is no longer a source of panic. Instead, it becomes a chance to buy more of your chosen investment at a discount. This psychological shift is perhaps the greatest benefit of dollar cost averaging. It helps you stay in the game for the long run, and staying invested is the most critical factor for success. It is not about being a genius, it is about having the endurance to stick with a sensible plan through thick and thin. The story of the tortoise and the hare is a perfect metaphor for investing. The hare is the market timer. He is confident, flashy, and believes he can outsmart everyone. He sprints when he thinks the time is right, then stops to rest, sure of his victory. He might get ahead for a short while, but his strategy is based on sprints and guesses. This is like the investor who tries to jump in and out of the market, betting big on a gut feeling. Sometimes it works, but it is an exhausting and risky way to run the race, and one mistake can wipe out all the previous gains. The tortoise, on the other hand, is the dollar cost averager. He is slow, steady, and maybe a little boring. He is not trying to be a hero. He just puts one foot in front of the other, day after day, without stopping. His plan is not based on predicting when the finish line will appear, or what the weather will be like. His plan is simply to keep moving forward at a consistent pace. This is the investor who makes a regular automatic contribution every month. It doesn't look like much on any given day, but over the course of the long race, this unstoppable consistency is what wins. The financial world loves to celebrate the hares. We hear stories of traders who made millions overnight on a risky bet. These stories are exciting, but they are the exception, not the rule. For every successful hare, there are thousands who tried the same thing and lost everything. The media rarely tells their stories. The tortoises, however, are all around us. They are the people who quietly contribute to their retirement accounts from every paycheck for 40 years. They don't make headlines, but they are the ones who reliably build lasting wealth and achieve financial independence. Ultimately, the best investment strategy is the one you can stick with. Dollar cost averaging is powerful because it is simple and behaviorally sound. It aligns with the reality that we are human and cannot predict the future. It encourages patience and discipline over brilliance and daring. By choosing the slow and steady path, you give yourself the best possible chance of reaching your financial goals without the sleepless nights. Remember, building wealth is not a sprint, it is a marathon. It is about the power of slow, steady, and unbreakable compounding. Follow for more plain truth about money.